Hello and welcome to the Business Standard Morning Show. I'm Veenu Sandhu. Let us take a look at the stories for the day. From bringing people together and fostering friendships to spreading misinformation and propagating hate and violence, the conversation around Facebook and social media has changed drastically. The Facebook Papers, a set of leaked internal documents from former employee turned whistleblower Frances Haugen, talk about how the social media giant should have done a lot more to curb the spread of hate and violence around the world. These leaked papers give examples from India and the US. Now, this could well be the final nail in the coffin before countries around the world bring in regulations for social media companies. Here's a look at what's inside the Facebook papers.
All that we suspected about social media, that it advances hate-filled content and induces anxiety and depression among youngsters, seems to be increasingly coming in the glare and drawing regulators' serious attention. The Facebook Papers, the social media giant's internal research documents, leaked by former employee turned whistleblower Frances Haugen, suggest that Facebook was acutely aware that its platform was being used to spread misinformation and propagate hate and violence in many countries. Haugen has also accused the company of harming children and weakening democracy. The Facebook Papers, among other things, suggest that Facebook's algorithm favors hateful content and that Instagram might be worsening body image issues among teenage audiences. The importance of these findings cannot be fully appreciated unless one understands the size of the Facebook universe. With an active monthly user base of 2.7 billion, Facebook has a 59% share in the world's social networking population. In India, which is its largest market by user base, Facebook has 410 million users. Add to that the user base of the company's other platforms. WhatsApp has 530 million users and Instagram 210 million. As much as 75% of the country's social networking population uses Facebook. If we undertake a deeper examination of the allegation against Facebook that it is promoting hate-filled content on users' news feeds, then we need to delve into what could be the possible incentive for doing such a thing. The answer might lie in Facebook's business model, which is advertising driven. Advertisers want more visibility and want to reach more and more users, and according to Facebook's own research, as revealed by Haugen in an interview to CBS's 60 Minutes, Facebook users stay hooked to the app when they see content that plays to their prejudices and inspires an angry reaction in them. She said, quote, Facebook has realized that if they change the algorithm to be safer, people will spend less time on the site, they'll click on less ads, they'll make less money, unquote. Facebook, meanwhile, has countered these allegations. Its CEO Mark Zuckerberg said, quote, the argument that we deliberately push content that makes people angry for profit is deeply illogical. We make money from ads, and advertisers consistently tell us they don't want their ads next to harmful or angry content. These findings are very relevant for India too. Last year, the Delhi Assembly was also probing the role of Facebook in instigating violence during the Delhi riots of February. The clamor for regulations for big tech social media companies is growing. But is it possible to rein in these big tech players who've grown bigger in financial muscle than most countries even? Recently, there were reports that India was considering revoking the safe harbor provision, which allows social media platforms to avoid liability in case illegal content is circulated on their platforms. Let's go to Business Standard's Neha Alavadi to understand the possibility of regulating social media in India.
In spite of the fact that India is its largest market globally, Facebook failed to invest in moderators who could look at content at least in the 22 official languages. To say that they were not able to do that, or they could only do it for Hindi and Bengali, it doesn't really cut the ice, or it doesn't really help their case much. Maybe one way to look at it in terms of solutions could be the government and regulators sitting down with these social media platforms and mandating at least a baseline of content moderators, in baseline, at least for those 22 languages, and then take it forward from there. Content has been, a contentious issue with the government. Of course, the IT rules that came out earlier this year have been, they've also looked at content as, a huge issue. And misinformation and hate speech is also something that the government has been talking about curbing on social media platforms. So it would make sense to, maybe if not mandate, then have a baseline of content moderators that can at least help platforms to look at these things. Of course, Facebook has said that they had a lot of third-party content partnerships, but their own internal research shows that when you click, this researcher who went online was directed to a lot of hate speech by accepting the auto suggestions or the algorithmic suggestions that they got. So that is something that is for Facebook to fix. But, at a very base level, this is something that they can do. And the fact that India is their largest market, but 87% of their investment in systems and people goes to the US and European markets says a lot about how they're looking at this.
Dixon Technologies CMD Sunil Vachani has been a proponent of the performance-linked incentive scheme for IT and component manufacturing, and his company has traveled across various sectors. In an exclusive interview with Business Standard's Shurajit Dasgupta, Vachani speaks about what Dixon wants to achieve through the PLI scheme, its planned investments and acquisitions. Let us listen in.
You have been a big proponent of the PLI scheme which the government has come out with, and you have traveled across various sectors. What was the reason for this? And if you can give us briefly the overall strategy which you are looking at through this PLI scheme to achieve.
I think there is no doubt in my mind that the PLI scheme launched by the Government of India for various product categories is an absolute game changer. And the reason I say that is because first, it helps Indian companies create large scale, which was really required to be globally competitive. It also helps companies build a strong and vibrant component ecosystem. It'll also help create Indian champions because, as we know, there is a parallel track for Indian companies wherein Indian companies can get benefits. If we take an example of mobile phone PLI, Indian companies can get incentives on all values of a telephone, whereas other companies get a value incentive on $250 and above. So this will definitely help build 10, 15, 20 champions across all product categories. As you know, we were one of the first companies to start off manufacturing of mobile phones with a new factory at Noida. We set up the factory in a record time of just about 5 months after getting the first PLI approval for manufacturing mobile phones. We also tied up with a large brands and companies who have very, very dominant market shares, both in the domestic market and the international markets like US. So we were really the first off the block. And now I'm very happy to see that we are scaling up. We have reached a certain scale, and we hope to, in fact, set up our second plant under the PLI scheme, again at Noida for mobile manufacturing, which will have a much larger capacity of almost 35 million pieces per annum. And this is going to be one of the largest plants in India by an Indian company with an area of almost 1 million square feet. We have been selected by the Ministry of Electronics for the hardware PLI scheme. And we hope to roll out a first product by January, which could be laptops. And we're also looking at various other product categories in the IT hardware space. We're also one of the companies selected for the telecom PLI, and we are looking at the consumer premises equipment, things like modems, GPONs, and routers. And we'll also be hopefully looking at the segment of wearables and the hearables, which is the true wireless sound, where we have a tie with a very prestigious Indian brand. So I think This is definitely an engine for growth for the company.
What is the kind of investment that you are looking at, and what is the kind of revenues do you think if you expect from this whole move?
The revenues that we're targeting, I think we will hit the ceiling revenues this year and hopefully next year. A point I did not mention, we are also selected for the LED lighting PLI, where the entire corpus is going on creating a component ecosystem. And once again, I would like to congratulate the Ministry of Commerce and DPIIT for having really listened to the voice of the industry and allocating the entire corpus onto creating a strong component ecosystem. And lighting was one industry where already 95% of the total Indian demand is being met through local manufacturing. So in that kind of industry, I think there was a need for creating a strong component ecosystem. And we've also participated in this and hope to get selected as one of the beneficiaries of this PLI scheme for LED lighting components.
So if you look at your existing revenue and with the PLI scheme, where would you be? What is the next 3 to 4 year plan that you're looking at?
Next year, we should be targeting at least around 20,000 crores, and this year, at least around 12 to 13,000 crores, if not more, on a conservative basis. So that's the revenues that we are looking at. But as I said, eventually, the vision of the company is that we should be in the top 10 EMS companies, global top 10 EMS companies in the next two and a half, 3 years. My understanding is that about 40,000 crores, we should be in the top 10 companies. And hopefully I see ourselves achieving that turnover, in the next few years' time.
If you look at the global ODM players, most of them have factories in different locations across the world. As you now look at a pretty large growth, would you be looking at that as an option?
If you see right now, our complete focus is on setting up our manufacturing footprint in India. And the reason I feel is that there can be no better place than India right now to set up manufacturing electronic hardware. And I think the reasons are very clear. We have a large pool of talent and labor. So, there's a huge competitive advantage. There are significant and amazing government policies and initiatives which have already been in place. And I talked about the PLI, there are schemes like SPECS and many more schemes which the government have rolled out. In terms of taxation, if you see, I think we have the lowest corporate tax anywhere in the world for new manufacturing units, which is around 17%.
Today with the PLI, are you competitive with China?
Yes, we are definitely are. And, the proof of the pudding, they says in the eating. And I think we were very excited and happy to announce our partnership with a large US company called Orbic, where we are going to be exporting our mobile phones to US markets. First, in fact, lot was already dispatched, and this is going to be apparently sold or bundled through carriers in US. So the fact is that customers are trusting us, are entering into contracts with us, and this shows that now as a country, thanks to the PLI, we've already become competitive. But the focus is going to be now on to ensure that going forward, we need to be competitive even without the PLI benefits. You see, because 5 years is just going to pass like this.
So will you also look at acquisitions to build capacity if that is required?
I think one of the objectives of the company is that we want to get into more and more design-led manufacturing. We also want to invest in backward integration, which really adds strength to the company, which builds a moat around the company's operations. So for that, I think we would be looking at both organic and inorganic, and we would definitely be open to acquisitions, especially in the area of design, right, where we feel that some company which has already done a lot of work and it is an advanced stage in different product categories, we would rather go in for an acquisition rather than trying to reinvent the wheel ourselves.
Thank you, Sunil. Wonderful.
Thank you so much for having me, and always a pleasure, of talking to you.
The much-awaited IPO of FSN E-commerce Ventures, which owns Nykaa, is open for subscriptions tomorrow. Valuation concerns and the need to examine wellness products personally before buying them are some factors that analysts are concerned about. They feel that these could impact the company's fortunes in the long term. In this report, D Street experts break down the risks for you.
FSN E-commerce Ventures, the operator of online beauty stores Nykaa, has fixed a price band of 1,085 and 1,125 rupees for its maiden public share sale. The issue is scheduled to open for subscription on October 28th and close on November 1st. At the top end, the company will be valued at 53,200 crore rupees or $7 billion. This will be the biggest IPO since Zomato's 9,375 crore rupee offering in July this year. Currently, the company is commanding a grey market premium of 610 rupees. But is it reason enough to subscribe to the issue? Let's go to Arun Kejriwal, founder of Kejriwal Research and Investment Services, to know more.
Current market fervor, optimism, euphoria, etc. makes these fintech companies, platform-driven companies, command a valuation which is irrational, exuberant, immediate short run, just post Diwali before 15th of November when the share gets listed. I believe they'll be able to capture at least 60-70% of the premium that is being quoted now, if not more. So the price is expensive compared to valuations of others which are non-existent. Therefore, it looks expensive. But if there is, I believe the anchor book will be mind-boggling when it is announced tomorrow. So once you have an anchor book which is compelling and forces you to apply, you may have to change your decision. So the kind of margins that she talks about that she's getting, I don't know whether it is going to be sustainable. She has certainly been helped in her business in the last 15 months by the pandemic. So whether that pandemic period now getting back to near normal, I'm not saying normal, but near normal, whether that will continue to give her that particular kind of growth, I don't know. Second, fashion. We have seen fashion. There are millennials around me in my building, etc. The kind of parcels that come for them, couriers, and the kind of returns they do. It's a joke. It's quite an expensive affair in fashion. Today we are in a euphoric mood, so many of our thoughts get sort of isolated. Today it will do well because you have got so many driving factors. But whether this thing can be sustained 6 months down the line, 12 months down the line is debatable. So you want to enjoy the listing gain, the listing pop, go for it.
Deepak Jasani, head of retail research at HDFC Securities, shares some of these concerns. Listen in.
Q1 numbers were soft, maybe due to the COVID impact. One will have to see whether the performance will recover sharply from Q2 onwards. Now, internet companies' valuations discount too early of the earnings of distant future, and that is why there is an expectation that in future they will keep growing revenues and profit and become profitable at a good pace. The company can face competition from other companies existing as well as those which may come in future, and can get impacted by disruption in its business model. Acquisition of customers, retention and return of customers for the business are very important. Also, increase in the number of orders, increase in the value of average order size are crucial for fast increase in revenues. Operating margins are very low, mainly due to high employee and other expenses. Revenues will have to expand fast so that the profitability will be something to be talked about in the next 1 or 2 years. Now, the company could also get impacted by future broad sell-off in the internet stocks if they as a group take too long to turn profitable.
As regards markets today, volatility could be high as investors will prepare for the monthly F&O expiry, also due tomorrow. That apart, stock-specific action amid corporate results will continue to dominate the trend. over 100 companies are set to announce their Q2 results today. These include ITC, IndusInd Bank, L&T, Maruti Suzuki, and Titan Company. Globally, crude oil prices, movement in the US bond yields, and FII activity will also impact settlement.
The complex world of startups is filled with an even more complex mini-world of jargons. You hear about various kinds of fundraising. There's angel investments, Series A, B, C, and more. And then there are also incubators, accelerators, PEVC investors, and corporate investors. Now, how do they differ from one another? Here's an explainer for you.
Thinking of starting up? Well, this explainer is just for you. Startups often raise funds from external sources like investors. But wait, there are several different types of investors. They are differentiated not only by the size of their investment, but also by the stage they typically come in. The first investor type that an entrepreneur usually approaches is friends, family, and personal contacts. At this stage, they are essentially investing in the idea, and so past familiarity is essential. The money on offer could be between $1,000 to $200,000, and this is what is called a seed round. A founder can also go and tap angel investors. These are accomplished professionals with a high net worth and past experience in investing in early stage companies. Apart from the money, angel investors also help with professional connections that could come in handy for a number of things. You also have angel investor collectives like the Indian Angel Network. Many HNIs are part of these collectives. Often, multiple angels end up investing in a single deal when it comes to angel collectives. In the early stage of a startup, founders can also go and sign up at an incubator or accelerator. These offer month-long programs that help founders set up their business and refine the ideas. Sometimes incubators and accelerators also invest in startups. A case in point is the hugely popular Y Combinator. Considering that a business is off the ground, for the next stage of capital, the entrepreneur can go to a venture capital firm. VCs are the holy grail of investors for fundraising entrepreneurs. A typical VC would invest $1 million to $100 million across Series A, B, and C rounds of the company. This is basically lingo for the first, second, and third major investment rounds. Some startups go for the family offices route to raise money. A family office is basically the investment arm of the founders of any successful enterprise. Just like anyone else, family offices invest in startups to diversify their investments. If the startup is doing well in a particular sector, it may also attract funds from a corporate investor in that sector. Corporate investors are essentially companies. From time to time, they pick up stakes in or acquire other companies in order to grow. These investors can be great allies in terms of market access opportunities. The last bit is private equity firms. PE firms are deep-pocketed investors and come in at late stages. What differentiates PEs from VCs, apart from the check size, is that PEs often buy controlling stakes. They are known to instill rigorous discipline in terms of costs and management practices in the firms they invest in. So, to recap, there are a wide variety of very different types of investors. Some are specialized in the stages and funding rounds, and others may have a particular affinity to certain sectors. That said, these lines are increasingly blurring these days.
And that's all we have for you today. We will be back with more news and analysis tomorrow morning in our next episode. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.